Hello and welcome to the MitchiMoney podcast. Today we're going to be talking about cash flow property investing. Okay, so before we kick into that, I just wanted to introduce myself. I am Andrew Mitchell, the founder of MitchiMoney, where we help people generate six figures plus in retirement using our perfect retirement blueprint without the need of expensive financial advisors and things that you can do and implement yourself. And that's what we wanted to focus on. Today is sponsored by our software, Mitchi.io. So if you need to help with budgeting, money management, setting financial goals and achieving wealth, then you can actually check us out at Mitchi.io. And you can sign up to our software. Okay, so we're going to be talking about cash flow property investing. So the first thing is people go, well, what exactly is cash flow property investing? So first and foremost, cash flow property investing is when, or any type of cash flow investing, is when you prioritize cash flow received as in income or revenue over capital growth. So that's one of the main things that you want to look at, because your total growth in any asset that you invest in usually is a combination of capital growth and also the dividends or the rental or revenue that you receive as income or yield, basically. So when you're talking about, let's just choose a property that's growing at 5% a year, and if you're getting 5% return on your investment every single year, so if it's a $500,000 property, it's growing by 5%, and you're getting 5% return, you're getting $25,000 approximately of capital growth, and you're also getting $25,000 approximately of income. So that would be a 5% rental yield and a 5% capital growth of overall 10%. So each strategy has different reasons why you would invest into it. So capital growth is usually good for a long-term investment strategy, and its delayed gratification is the fact that you're letting the capital growth compound over that time frame. But sometimes we need cash flow investing to help us through our day-to-day lives. It could be that we need the income, we need to obviously supplement our retirement, we need the lifestyle, whatever it might be. We might have a debt reduction strategy. There's a lot of reasons why a cash flow investing strategy would be more suitable. I'm a big firm believer in both. I love cash flow investing for property. I love, as everyone probably knows, is index fund investing for capital growth. Also, your superannuation is there as a safeguard as well. But with our software and with our business and the way that we go through the perfect retirement and investing, we like to make sure that we're hitting our financial goals, retirement incomes, without the need of superannuation as a conservative basis. And then your superannuation, if you fall a little bit short, can be helped there to bridge that gap. Okay, so when we're talking about cash flow investing property, it's really, really powerful strategy that you got a lot of benefits. So let's go through some of those benefits now. So you can use a cash flow strategy to help fast track paying itself off or its own investment debt. That basically gives you greater passive income faster because you're going to have a lower debt paid off sooner, and it's going to increase your passive income as well, and it's going to create equity faster by paying the debt down as well. So one of the things is that I did go through, and I'll put it into the description here, is I did a video of an example, and I'll just quickly go through the figures with everyone now. Is the example went through two properties, purchasing them as a cash flow investing, so two $500,000 properties. Again, the deposits, all those sorts of things. We just assume that you could use equity for it. So those two properties, let's just say $500,000 each, 8% rental return, which is actually pretty low for a cash flow investing strategy. Cash flow investing strategy should be around anywhere from 8 to 12%, and then you're going to be getting capital growth. And I just use CPI or inflationary figures as the capital growth. So it's just growing with the general cost of living and money and everything like that. So it's not technically going up. The value is, but obviously with inflation, our money is worth less tomorrow than it was today. So we just allow the property value in terms of the capital growth to keep up with inflation, and we just use a 2.5% figure. So if inflation's a bit higher than that, then we're being conservative, and it's a bit lower than that when we're being a little bit more aggressive, but it's pretty conservative in the grand scheme of things as well. So back into this example. So if we've got a $500,000 property, and it's probably cost us $25,000 in costs, $15,000 in stamp duty, depending on where you're living, maybe a little bit more, some additional costs on legals and all those sorts of bits and pieces. So you're driving about a $40,000 a year income from that one, and let's just say your net rent is around about $34,000. So you got $5,000-$6,000 worth of rates, insurance, and bits and pieces as well. So you're getting your $34,000 of income, and then you've got repayments that you need to make. But that income, a lot of people use that $34,000 to do their figures for the next 20 years. But what will happen is not only does your growth keep up with inflation, but your rent also goes up by inflation. Everyone's seen rental increases lately across the market, and the rental market's extremely tight. Look, your rent's not going to be increased by 2.5% every year. You might not increase it for 2 years, but then you might increase it by 7%. So as an average, it's going to increase by around about CPI inflation or more. So over that 20 years, we're just going to use a 20-year example. If I had originally bought it and I'm getting $34,000, at the end of that 20 years, my investment property is actually deriving $54,000 a year, $54,350 as a net. The gross rent's about 65. You got about 15 about 10, 12,000 off costs or whatever it might be. So we know that one property in 20 years is going to be giving us 54,000. So two properties in 20 years is going to be giving us 108,700. Again, these are just figures based on an example. But what we need to do is at the first year one, we're only getting $34,000 in rent, but at year 20, we're getting a hell of a lot more. So what you've probably already realized as I'm talking is your rents go up, but your interest will forever be decreasing down. And the reason that is because you're paying it off faster, your rent gets calculated on your balance, and you're paying more into that as a debt reduction strategy. So as an average across that 20 years, the rental income, the inflation adjusted rental income as an average is about $43,425. So if we would average out all of that across those 20 years, you're getting a little bit less at $34,000 at the start, and then you're getting obviously more at $54,000 at the end. So we took the middle road, and $43,000 is the average, which means that strategy with two investment properties getting the $43,425 or whatever it might be, it gives you $86,850 in income. You've got $63,840 in costs, which leaves you with about $23,000. Take off 30% tax. Look, again, depending on how you structure it, if you can funnel it into a lower income person through trusts or whatever it might be, great. I'm just using 30% as an average. That leaves you with about $16,000 surplus. So we use that $16,000 as an average as a debt reduction strategy. And over that 20 years, you'll have both of those properties completely 100% paid off. So straight away, in 20 years' time, you've paid off two investment properties, giving you $108,700 in income gross a year. On top of that, you haven't had to contribute any money to the strategy at all. That's $0 out of your own pocket. If you had to pay the deposits out of your own pocket, look, you can save up for the deposit over 5 or 7 years and then get into a cash flow investing one. This isn't the podcast or to go through the deposit side of things. We'll do another one on specifics on deposit raising, all those sorts of things. But that's the first benefit that you can have a look at is if you buy a cash flow investing strategy or you implement a cash flow investing strategy, you can use itself to pay itself off very, very quickly. So that's the first one. But the next thing that we look at is, okay, well, if we've got a cash flow investing strategy, what else can you use it for? You can use it to pay off your principal place of residence faster as well. So that's a really good example. Is, well, would we contribute to a cash flow investing strategy to pay itself off first, investment debt, or would you actually use it to pay off non-deductible debt? And the answer would always be, well, it depends. But my preference always, and I think most people would agree, is that we should always use the cash flow to pay off non-deductible debt first. Because if we start focusing on paying off the deductible debt, we're going to decrease the interest charges on that investment loan. We're not going to have as many deductions, which means we're going to pay more tax because it's going to be a higher surplus. And then we're going to still have to pay the debt with after-tax money. So we may as well use the cash flow to pay the non-deductible debt back. What does that do? It creates a faster, or improves your net position far quicker by decreasing the debt on your principal place of residence. And then once you've paid that completely off, then you can funnel your money into obviously the investment debt reduction strategy. Another thing is that you could use the passive income, and a lot of our clients do this as well, is they utilize that passive income. They don't want to pay their debt off at the moment. They want to diversify at this stage, and that's fine. It's just a personal preference based on what you want to do. And they use that cash flow or the additional money that they get from a cash flow strategy, and they invest it into index funds, individual stocks. Some do it in crypto. It's completely up to the individual, but the fact of the matter is they can use it to diversify their assets into additional assets that can diversify their portfolio. So that's the third thing that you can look at with a cash flow investing strategy. Another one that is quite common as well is people adopt this strategy because they know for a fact that in a few years, so they start with a debt reduction strategy, whatever it might be, and then in a few years' time, they know that they might have kids or they might have educational costs, they might have additional things coming up that they need to afford, and they use it to help supplement or bridge that gap between their income and what they need in terms of their expenses. So they can actually use the passive income to supplement their lifestyle. lifestyle, or pay for these expenses, or pay for children, whatever it might be. And that's actually quite a common one as well. Or the next thing is you can help it save with an emergency buffer in times that you need additional cash flow. And look, one of these strategies, and this is a perfect time to have a chat about it, and the reason I brought it up is the fact that it's a fantastic strategy in rising interest rates. As interest rates rise, we have in Australia one of the highest debt to income ratios in the world. And that means that any impact in terms of the interest rate, 1% rise has a dramatic impact in the hip pocket of everyday Australians. So that means if you've got a little bit of a safeguard in terms of a cash flow investment strategy, you might have a mortgage and your mortgage goes up by 1% and it's going to cost you let's just say it goes up by 1.5%. It's going to cost you an extra $700 or $1,000 a month. But if you're getting an extra $700 a month from your cash flow investing strategy, that puts you in a really good position to be able to still maintain your mortgage. It reduces a lot of anxiety for people because they've got that additional cash flow that they can put into those in emergency cases as well. And usually that helps in that regard. So that's why I think it's a fantastic strategy, is that across the board, you can use it to do a fast track debt reduction strategy, whether or not it's a principal place of residence, whether it's consumer debt, whether it's an investment debt. You can use it to pay it off and increase your net worth far quicker. You can use it to pay off, create equity and invest faster, or buy your next property faster. You can use the passive income to supplement your lifestyle. You can use it for creating emergency buffers in times that you need it. You can use it when the rates are rising to help supplement the rising costs of living in terms of your mortgage, fuel, whatever it might be. You can utilize the strategy far more greatly than if it was just you're focusing on negative gearing. And the benefits that cash flow have over just general house and land or newer purchases that are quite often spruiked as well. I'm not against them by any stretch of the imagination, but we're going through the benefits here for a cash flow. And if you're relying on negative gearing to afford your property, if the rates go up, your negative gearing benefits do go up because it's costing you more money. But it can easily go from costing you nothing strategy to costing you a substantial amount of money if the rates jump up by a substantial amount. And then you've got not only your investment property where your rates have gone up, you've also got your principal place of residence that's gone up. And let's just say you've got a property portfolio, you've got 2 investment properties and you've got your PPR. If interest rates go up by 1.5%, you're potentially going to be around $2,000 a month worse off across the 3 properties, which that's a lot of money. That's $500 a week after tax. So this is where people get stuck and they get themselves into trouble, especially if they've got car loans, if they've got some credit card debt. It really is the final nail in the coffin. Look, is it going to get to that stage? The RBA is pricing around 225 to 250 basis points increases. I don't know if it'll go that high. It will definitely go up. The reason I don't think it'll go high is our debt levels. As I mentioned earlier, we've got a really high debt to income ratio, which means that any adjustment that the RBA make in terms of interest rates is going to have a dramatic impact on their hip pocket because our debt levels are so high. So that means that they can turn the dial a little bit and it can have this really big impact on the back end. So they're a little bit gun shy, and that's why. It's because we've got such high debt levels. If they dial it too quickly, it's just going to really impact the market. Well, they don't want to throw us into a recession, obviously. So that's why they're just going to dial it slowly and see what the actual effect is on the real inflationary figures, cost of living, on those sorts of things. So that's the main benefits on why I absolutely love cash flow investing and why I think that cash flow investing should be something that everyone considers for part of their strategy. First and foremost, another reason is retirement income. A lot of people think they're working towards, oh, look, I want to retire at 60, I want to retire at 58, I want to retire at 55. Look, I think throw that out of the water. Think of it in terms of a dollar figure. If you can give yourself X amount of income a year, you can basically retire whenever you want. Now, think of your situation now. Think of it right now. If someone was to say to you, I'm going to give you for the rest of your life an X amount of income, how much do you want that you would be able to retire? Are you going to keep working if you enjoy it, perhaps, but you're probably going to change your lifestyle a little bit and probably not work as much. It's going to be less stressful, all those sorts of things. So what you want to do is work out what you want in retirement in terms of income, work a strategy towards getting that, and then you can retire, whether or not that's 45, 55, or 65. That's really how we like to work towards it, because a capital growth strategy is fantastic over the long term, but if you want to retire and you want to be able to just have consistent income, cash flow can help with that. So that's the main benefits that I think on why you should consider a cash flow investing strategy. But what about the cons? Because there are some. With every pro, there is a con. So if we're looking at cash flow investing strategies, we're talking 8 to 12% in terms of our rental yield, and we're talking around about 2.5 to 3% in terms of capital growth. So we're talking 11 to 15% return on investment, which is pretty similar to a capital growth property. Look, they're going to be returning anywhere from 8 to 15% as well. So in terms of the gross returns, there's not, as long as you choose the right types of properties, there's not a big difference. It's about how that breakup is designed for you as well. So this is where it comes down to it. Good cash flow properties are harder to find than just generic properties in the market. On the market, there's lots of properties. You got lots to choose from, and they mostly suit just mum and dad, people that are just not sure what they want to do, and they're just buying an investment for the sake of buying it. They're buying somewhere around the corner from them, in the suburb next door, or in the same city that they understand. With cash flow investing properties, you've got to throw that thinking out of the window completely. You're talking about a really commercial decision. You'd go data driven. Okay, you want to have a look at the population densities, the migration figures, the type of work, the types of infrastructure projects that have been there for the last 10 years, the type of infrastructure projects that are planned for the next 10 years. Private, public schools, primary school, secondary school, do they have tertiary education? What's the blue collar workings like? What's the average income of the area? What's the breakup of the family? Is it usually 2 plus 2 kids? What's the, when you're looking at the areas, what's the distance to that location to pubs, clubs, the schoolings, the train station? What's the transport infrastructure like? What's the private spending going to be in that area over the next few years? What's the rental yields been over the past? Why have they gone up? Why have they gone down? Is it going to be stable over the future? What's the distance between the nearest capital cities? Where's the nearest airport? All of these are just generic things that you go through, but you really want to have a look at what are the owner occupiers compared to investors in the area? What are the types of properties in the location? Has the council changed subdivision rules or zoning rules recently? Why did they change those zoning rules recently? All of this is part and parcel of our property investment course. We go through the data driven so that we can actually go to areas with, okay, well look, you mightn't like that area. Who cares about you? Do you care about making money? And that's what it's about. Data driven areas, and that's what we need to focus on. That's what we need to find. And with cash flow investing properties, and I should have actually mentioned this a little bit earlier actually, is you're talking about, and if you remember well, what constitutes a cash flow property investing? A cash flow property, is that it's basically generating you, like I said, the 8 to 12% plus, ideally. But what's the breakdown? Usually it's multi-units on one title. This is where it comes down to some of the cons that we'll go through in a second. It's harder to finance a multi-unit as it is to one-on-one title. So we'll touch on that just a second. So they're actually harder to find, and that's why we follow the data. And that's one of the cons, because you can find a lot of things online. It's going to take a little bit of time, a little bit of effort, a little bit of resources to find that. It's all public information, and that's what our courses go through, is the fact that, look, it's all public information. You just got to know where to look, but you've got to know what to look for as well. There was actually a statement that came up that I think Gen Z, I think they might have mentioned Gen Z, are the most uneducated. And again, don't kill the messenger. I'm not talking uneducated in the sense of it, but uneducated in financial planning, financial money management, and those sorts of things. And their question was asked, well, why? They've got the most information out of any generation in the world, or ever in any generation. And that's part of the problem, is online these days, we don't know what's true, we don't know what's fake, we don't know what's in between, we don't know if it's data driven, whether or not it's personal opinion, whatever it might be. So there's so much misinformation out in the market at the moment, and globally, that you're not 100% sure what's correct. And a lot of people believe the things that aren't necessarily correct. So that's the problem, is the fact that back in the day, it was harder to find the information, but at least the information that when you finally found it was more reliable, because it came from more reliable sources, because the reliable people were the ones that were putting out the information and doing the research. Now, anyone with an internet connection can post anything, and a lot of people post things just to be opinion based, because they want to go against the general consensus as well. So that's why I think that having the confidence in a program, in a situation, is the most beneficial. So do your research, due diligence on whoever you work with is a really important point. And if it's online, take it with a grain of salt unless it's research backed. Okay, look, there's a lot of things, take them as a grain of salt so that you can actually protect yourself. So it's harder to find, so it's going to take more time, more research, more effort to locate those properties. As long as you use the implementation strategies that we've got with the types of areas, what you're looking for, that you'll find the right types of properties. The next thing is because you need to do more research, it can take a little bit of time. So some people are time poor, and because of the types of properties that you're looking for, they're most likely going to be outside capital cities. So one of the things that people find is they're more comfortable about investing in capital cities or in their own capital city. That's not it's not a sound investment decision. The reason being is invest where the figures actually stack up. So because you're out of the capital cities, you need to have the confidence in the areas, and that's where it comes down to making sure that you've done your research. So again, it comes down to it's a little bit more outside of people's comfort factor because it's not generally just a house, block of land or a unit in a capital city or an outlying suburb where people are confident about it as well. Usually in capital cities, the prices are high, which means that the rental yields are low. But even having a high price and a low rental yield still gives you a really high rent for one specific property. For example, down here on the Gold Coast, you can't get a property in Palm Beach for, goodness me, I think $1.5–2 million, but you might only get $1,000 a week in terms of your rental. So you're only getting, depending on your price, you might only get 3% return, and after you're paying your rates, insurances, all those sorts of things, you're down to about 1.5%. And I don't know about you, that's not a really good return at all. And will you get the capital growth? Potentially over that time frame, but the holding costs can be skyrocket, especially if you don't have a tenant. And that's just one tenant. And the higher priced, if people can't afford $1,000, you obviously your vacancy rate's going to skyrocket, your out of pocket's going to skyrocket, and then potentially you might have to sell that property for a loss, depending on the market as well. So next thing is financing restrictions in terms of a con. If you have to come up with your own deposit, you might have to save a little bit more in terms of just a normal investment property. If you're just an investor and you're going and buying an investment property, you can sometimes finance 90–95%, depending on your circumstances. Obviously, you can discuss with your mortgage broker those sorts of things. But with a multi-unit on one dwelling, you're usually buying 3 or 4. Look, a lot of them don't like it. There's still a lot that do, fantastic, and they can go up to sometimes 80% LVR. So with the 80% loan to value ratio, you might have to kick in a slightly higher deposit. But the good thing about it is that we're looking at properties that are lower priced as well in regional areas, so anywhere from $300,000 to $750,000, as opposed to capital cities, where a lot of people in Sydney, Melbourne, Gold Coast, they're looking at the plus $1 million range, which even if you're doing a 10% deposit, it's still $100,000 deposits, where if you drop your price down to $500,000, you find it, your 20% is $100,000. So you're sort of still sitting around the same amount in terms of your deposit amounts. You can go less again, but that just gives you an idea, because a lot of if you start going higher as well, 4, 5, 6 units on one title, some of the banks start considering it based on commercial policy, which means that loan-to-value ratios can drop down as well. Interest rates can increase. So what you want to do is, if you're doing this strategy, you want to try to stick towards a resi policy as much as you can, because you're going to get better rates, you're going to get better LVRs. But again, this is why a good mortgage broker is worth their weight in gold. So use a good mortgage broker that has experience with multi-units on one dwelling, that they can help you out. And look, they'll be able to direct you in the right way in terms of deposits, equity, all those sorts of things with the structure and all that as well. So what we want to also look at is you're taking the cash now, okay? And what I mean by that is, remember I spoke about cash flow and capital growth, and the combined cash flow and your capital growth is your return on that investment for that year or that time frame that you've held that asset. So what you're doing, and this is something to be aware of, not that it's a bad thing, it's just something to be aware of, is when you're investing in a cash flow investing strategy, you're taking the cash flow now as opposed to the capital growth. So the capital growth, we've just used CPI. So we're basically saying this property is not going to go up. And I personally don't care about the property going up. And people go, well, why don't you care if it goes up or not? Well, as long as it's rented, as long as I'm getting my rental yield at the percents that I've invested in, my return on investment is my cash flow. I'm retiring on cash flow. I'm getting my income. As long as I've got my 6 figures plus income, I'm happy days. So at the end of the day, a lot of people go, oh, well, if it's not going up in value, well, it's not working. Not true. It's about what you want. So I'm happy to forego capital growth to get my cash flow. So you mightn't be. That's fine. Don't go cash flow investing. Go capital growth investing, and that's fine. I prefer index fund capital growth rather than capital growth properties. Why? Index funds are diversified across multitudes of industries, multitudes of different facets. I think they're more diversified than what just one individual property is. But that's just me. Again, you might prefer to invest in blue chip stocks with high dividends as your cash flow strategy. that's your prerogative. I prefer cash flow properties. My background, my parents owned real estates. My background is property. My background is finance. And that's just something that I'm more comfortable with. I've seen the results in relation to that as well. So if you're going to invest in a cash flow investing strategy, just remember you're taking the cash flow now, which is why it's important that you focus on the cash flow component. Coming back to another point, is you can actually improve that property. One of the things that I always look at as well, if you're buying 3 properties or 3 units on one title, if the zoning allows you to whack up another unit on the back there, fantastic. Because in a couple of years down the track, obviously wait for the construction costs and material costs to come back down. Otherwise, you're not going to get the same return. But if you're getting a decent return on the 3 and you can throw on another $50,000 or $60,000 or $70,000, how much dwelling on the back, and get another couple of $100 a week in rent through $300 a week in rent, you can increase yourself. You might have been on a 9% yield and you throw that on. Yes, your debt might go back up, or it might cost you, so your yield might increase as well. So you might go from a 9 or 8, 9% to a 12% or 11% to a 13%. So you can actually add value, and that can actually then improve your capital growth as well. And look, this isn't, sometimes it may not be able to occur, but you can actually, if you keep it on one title, it's less costs, or less holding costs, because if they're all on different titles, you've got separate rates, you've got separate types of insurance for each individual property, where if it's on one title, you've got the one insurance, you've got the one rates, so your holding costs are a lot lower. And look, you might be able to strata them later on down the track if you wanted to sell them, which then straight away you strata them. If you can, again, it depends on the setup, depends on the zoning. It's all council approval dependent, obviously. And then you can sell it and you'll be able to get a lot more return on your money as a capital growth portion of it as well. And lastly, one of the cons, well, not necessarily a con, I think it's actually a good thing, is quite often some of these properties, well, they've seen better days, is a nice way of saying it, is the fact they might need a bit of TLC and a bit of spruce, a bit of cosmetic, might need some makeup and a bit of lip liner, a little bit of eyeshadow on them. So a little bit of cosmetic works might need to be done. I think it's a really big opportunity in terms of if you've actually got works to do on it. I don't want major things wrong with it. As long as structurally sound, as long as that's all done, look, you can buy flat pack Mitre 10 kitchens, flat pack Bunnings kitchens. They're actually quite cheap and you can install them yourself. You might need a little bit of help, but you can install them for fairly cheap. And most tenants at that price point, because the price of the properties are quite low, so your rents are quite reasonable and low, which means that the benefit is that even in the worst instances of job losses, high unemployment rate, people on the pension and all those sorts of things can still afford that type of rent. Where if you're investing in a higher priced property with $1,000 a week, like we gave in that example, not many people can afford that. So when we're talking about we're talking about an additional benefit for those as well. So coming back to the TLC, you might be able to get it, and it might need some cosmetic works to be done on the property. So you might need to do slap a paint, you might need to rip some carpets out, you might need to do some laminate floorings, you might need to do the gardens, you might need to redo the kitchen, and maybe redo the bathrooms. Look, again, that sounds like a lot, but you can get a fairly reasonable price now in terms of flat pack kitchens. Look, vinyl flooring, it doesn't have to be U-Butte, and you don't have to do it all at once. Is the fact that, look, you can do a slap of paint in the carpets if you want, or you might not do nothing, but straight away you're going to get better rental yield. But here's the big kicker: you're probably going to get better tenants. Because look, it's not just about the price point, it's about the quality of tenants as well. If it's clean and tidy, doesn't have to be Taj Mahal size, doesn't have to be Versace 6-star finishings, it just has to be clean, tidy, safe. And so that means you might need to throw some security screens on or whatever it might be. So clean, tidy, safe. And you'll actually get a fairly decent tenant in there at the same time. So they're the main things that you want to be focusing on those cash flow investing strategies. All right, so that's basically gives you a bit of an idea about cash flow investing strategies, how they work. So we'll go through some of the benefits like we went through. Using a cash flow investing strategy as a recap, cash flow investing strategy can help fast track you paying off debt, whether it's deductible, non-deductible debt. You can implement it into your strategy. It creates equity faster so that you can fast track an investment plan, or you can pay your debts off faster. You can use the passive income to diversify your portfolio, so you can invest in other assets if you wanted to, different types of assets. You can use the passive income to supplement your lifestyle. So if you've got kids, you've got educational costs, or you've got some lifestyle things that are coming up, you can use that strategy to help yourself, obviously, give yourself more income through that year. If it's structured correctly, you can obviously benefit greatly as well, utilising trusts. You've got strong rental demand due to the lower pricing, because at the end of the day, if you've got 3 units on one title at $500,000, you might be getting $300 a week in rent for each individual unit. Whereas opposed to if you had just bought a $500,000 property, you might be just having one tenant at like $500. Or if you bought a $1 million property, you might only have one tenant at $1,000. So it's much easier to find 3 tenants at $300 than it is at one tenant at $1,000. Also, when the rates go up, it's fantastic for having cash flow investing strategies because there's surplus cash. It's passive income. So if rates go up and you can't afford certain things, it can help again with your lifestyle or covering debts or covering itself as well, which I think is a really good idea at any regard. So, and it gives you that little buffer. So they're the main benefits of a cash flow investing strategy on why I consider them. Again, if you're retired, you can rely on that cash flow for your retirement income. Some of the things you need to consider is the fact that sometimes it's harder to find the right type of cash flow investing property. You need to do some more research because there's not as many of them, and to make sure that you're investing in the right regions, because at the end of the day, if you're not investing in the right regions, and this goes for any property, it's not going to get you the right return. Depending on how many dwellings you've got on one title, it can make financing a little bit harder. So if you're starting to go 5, 6, 7 units on one title, your loan to value ratios might drop down to about 60%. So it means you need more deposit or equity. And then on top of that, they might switch you over to a commercial lending. So that's one thing to look out for as well. And just remember that when you are investing in a cash flow investment strategy, you're taking cash now as opposed to capital growth. So you're getting the cash now as a cash return in terms of a return on investment, and you're forgoing a little bit of your capital growth in relation to that as well. And it might need some TLC because a lot of them may need a little bit of work to it. So you might have to factor in some additional cost to bring it up to standard, to get the best tenants, to get the best rental returns, and to make sure it's a really stable property for yourself. Look, hopefully that was really beneficial for you. My name's Andrew Mitchell. I am the founder of MitchiMoney. We help people generate 6-figure investment returns, passive investment returns, without the need of expensive financial advisors. Utilizing our software, Mitchi.io, you can budget money, manage your money, set and achieve your financial goals, and implement your strategies as well. So look, hopefully that was beneficial, and thank you very much for listening.